Welcome back, folks, to Investor Diaries. Following our video on mutual funds and ETFs, a few of you asked us to do a video on top mutual funds and top ETFs, and we'll talk all about it in this one.
So currently there are top two companies dominate the domestic mutual fund market, and these are Vanguard and Fidelity. Both offer funds with robust growth and growth potential and have trillions under their belt in total assets. So if you're looking to cash in on the potential advantages of size, here are the three mutual funds by their size or assets under management. So the first one on the list is Vanguard Total Stock Market Index Fund, Admiral Shares. It goes by the symbol VTSAX. Some key facts of this fund: the AUM is $921.4 billion. The expense ratio is quite low for a mutual fund, 0.04%. The 1 year performance has been 19.14%, and the 3 year annualized percentage is 13.21. For investors looking to invest a minimum of $3,000, this fund provides exposure to entire US equity market, which is small, mid, and large cap growth and value stocks. This fund was created in 1992 and has a whopping $1 trillion under assets under management, with more than 3,590 stocks in its holdings. Its portfolio leads with Apple, Microsoft, Amazon, Alphabet, and Facebook. So all the major FANG stocks, and it pretty much replicates the way the total fund or total market performs.
The next mutual fund in the list is the Fidelity SP 500 Index Fund, FXAIX. A couple of key facts as far as the Fidelity Mutual Fund is concerned. The assets under management, it is $274.1 billion. The expense ratio is 0.015%. As far as the performance is concerned, so the trailing 1 year performance is 17.44%, whereas the annualized 3-year performance is 13.16%. Now, the performance of this mutual fund will be similar to that of any other mutual fund that tracks the S&P 500. The top 10 holdings as far as this mutual fund is concerned, they comprise about 28% of the portfolio, and you have all the big tech names out here such as Apple, Microsoft, Amazon, Facebook, and Alphabet, amongst others. One of the big reasons why we at Investor Diaries are recommending this is because the expense ratio for a mutual fund is one of the lowest in the market here, and it's being recognized well by Morningstar, which we highly value here at Investor Diaries.
Now, the third fund on the list is Vanguard Institutional Index Mutual Fund, and the symbol is VINIX. The assets under management for this fund is $231.6 billion. The expense ratio is 0.035%. The 1 year performance was 17.44, and the 3-year annualized performance is 13.14. Now, this fund tracks the S&P 500 index as well, which tracks mostly large cap stocks. This is a passively managed mutual fund, and that's the reason it has a pretty low expense ratio. However, the minimum investment required here is $5 million, which makes it a pricey option for an average investor. The high buy-in is primarily the reason why this fund has assets under management under 231 billion mark.
If you're a long-term investor and are looking for funds to add to your portfolio, there are a lot of index funds that you can choose from. We spoke about the exchange traded funds in a previous video, and I'll link it in the description below. We'll highlight 3 of those in this video. These will be based on assets under management, long-term performance, and the expense ratio.
So the first one on the list is Vanguard Total Stock Market ETF. Its ticker symbol is VTI. The assets under management on this fund is $823 billion. The 1 year performance has been 9%, and its expense ratio is 0.03%. Now, if you're uncertain which index to follow, or you wish to invest across a variety of different sectors, different indexes, and different market capitalization, this might be the right fund for you. As the name implies, the total stock market ETF covers the entire domestic stock market of the US and tracking the CRSP US Total Stock Market Index. Now, VTI is a balanced fund with a healthy mix of small cap, mid cap, and blue chip stocks. It's a highly efficient fund, which means the fund has a very low expense ratio. The AUM is also pretty impressive for an ETF, which means you can take potential advantages of the size of this fund.
The next on the list is an ETF by State Street Financial Advisors. It's called SPDR S&P 500 ETF. The ticker symbol is SPY. A few key facts: assets under management $262 billion, 1-year performance is 10.15%, and the expense ratio is as low as 0.09%. This was the first to market ETF, also known as the granddaddy of ETFs, just because of all the history behind it. It attracts a lot of attention from tactical traders to buy and hold investors alike. This fund again tracks the S&P 500 index, which is a group of equities, mostly large cap, that are listed on the US stock exchange. This has a lot of investment in big tech such as Apple, Microsoft, Amazon, Alphabet, and Facebook. So technically, SPDR 500 ETF is a unit investment trust, which means that it cannot reinvest its cash dividends between distributions. This minor detail may cause the fund's performance to deviate slightly from the index on which it's based. So if you were wondering why the performance of this ETF is different to the other S&P 500 ETFs or mutual funds that we've spoken about, even though their expense ratio is pretty much the same, it is because of this particular reason. And the fund boasts of a solid 1-year performance of more than 10%. The next ETF on the list is by iShares, and it is called iShares MSCI EAFE ETF with the ticker symbol of IEFA. The issuer is iShares, whereas the assets under management today is over $63 billion. It's had a fairly impressive performance as of date, up to it's returned 25.06% to its investors, and the expense ratio is quite low. It is 0.07%, which means that out of a $10,000 investment, you're paying $7 as fees in a year. What it does is, or rather, why it's different to the other ETFs that we've spoken about, is because it delivers exposure to developed markets in Europe, Asia, and the Far East, excluding domestic and Canadian equities. Its benchmark index is the MSCI EAFE, and it covers 98% of the global equity markets outside of North America. Another difference to the ETFs we've spoken about is that it includes small cap stocks in proportion to the market, something that competing funds typically do not include. From a geography standpoint, Japan and the UK take the top 2 spots in the fund's portfolio.
So that's all for this episode, guys. We wanted to give you a highlight of the top 3 mutual funds and top 3 ETFs. Again, as we recommended earlier, if you're still new to the market and you do not want to get into the hassle of buying and selling ETFs regularly, the best option for you is mutual funds, which you can work with your financial advisor and the money goes out of your checking account, investing periodically into the market. And the mutual funds that we have showcased in this episode have fairly low expense ratio, taking out some of the advantages of the ETFs. However, if you're fairly comfortable with the market, you're fairly comfortable buying and selling periodically, then in that case, we would recommend going for one of the ETFs that we have covered in this episode. So that's a wrap. Please let us know your thoughts and comments on this video, and if there are any further topics that you would like to cover in one of our upcoming videos. Until then, stay tuned and stay focused.
Thank you.